key here is getting focused on what you're trying to do relative to where you're trying to go. And that just goes back to the simple strategies that we just talked about, is how do I get in and get out of a position relative to what my objective is. Now, the beauty of software today is we can do all kinds of interesting things. So if we look at this going forward, here's Apple. Let's move this right here. And so we're going to buy Apple at 110. So if we were to go into Apple and we said, all right, we're going to enter this at 110 on Apple. So here's our entry is right here, and that's our buy price on Apple. Now, what's our stop? Our stop was back here, if you remember, around 102. So we would have a stop over here at roughly 10. I'm just going to use round numbers here so we can put this on here. So on Apple, our stop is going to be across here. So if it crosses that little trend line right there, then we're at Apple at 102. So entry, exit, target was up here at 140, which is the white line. Now what we want to do is play what if. So let's start moving our chart forward, and over here, if we go back, let's go all the way back right here. So what we get is there's our entry. So we buy at 110, we establish our stop at 102, and we start going along, and you can see it's going up. And the next thing we want to ask ourselves is, do we want to raise our stop? In other words, if we bought it at 110 and it's at 125.40 today, do we still want our stop at 102? In other words, our risk now is $23. Before it was $8. Now it's $23. So what's happening is our risk has gone up proportionately to the market moving. And when I started this whole class, I talked about risk and volatility. Here is where risk really does come into play. This is how we measure risk each and every day. Risk is not Apple. Risk is the market. The market will dictate how much risk I have right now. In other words, my stop's 102, Apple's at 125. I have $23 of risk, or I now have a 20% downside risk. When I bought it at 110, my risk was 8.5% relative to the entry price. That is risk. That's real dollar risk to my money. And I just do not hear people talk about risk in that format. And I get on my soapbox about it because I think you have to manage risk relative to where you are today, relative to where you bought it, relative to where your stop is. And that's key to me. So at this point, let's grab our green arrow right here, and let's say we're going to raise our stop to our entry price, which is 110. So our stop is now 110, or our risk has become $15 per share. Fair? That's Money Management 101. That's getting the risk out of the portfolio. So in other words, if Apple fell out of bed tomorrow and it went to 105, I'm out at 110, break even, didn't lose any money. And now the other side of you, the greed side of you, saying, but Jim, I just gave back $15 of profit, or about 12% on the gain. Well, if you don't want it to be 110, define where you want it to be. And that's what my point is. You can put your stop right here at 118 and give up $7 of risk. But understand, you're trading a $125 stock. It can move $7, $10 a day. You can see on this chart, whatever day this is, that this was Apple was up $5. I mean, that when you're talking about a $100, $200 stock, it's going to move. And so give it some room for volatility, and let's keep trekking forward. So we continue to watch Apple. Our stop's at 110. Now all of a sudden now we're at Apple's at 132. We're at 110. See, we're getting back to that risk ratio again of $22 a share. So our risk is now rising relative to the price of Apple rising. And so therefore, what do we want to do? We want to get another line over here. This is a beautiful thing. We can bring all these things in. And we say, all right, there's support as I see it and that's around 118. If it fell to 118, I would lose $14, and that would be about a little more than 10%. I'm good with that. So let's grab our little stop doodad over here, and we're going to move our stop up to 118. And that's what we're going to do. We keep going forward. Now I'm going to give you the lecture again about why you want to raise the stop. But look what's happening. Apple's going down. Oh my God, it's at 119.49. Our stop's at 118. What do we want to do? Do we want to lower our stop because we don't want to exit this? Do we want to honor our stop? This is where you start to get in the psychology. Remember, you're still in a profit. We own it at 110. We're at 118 on the stop, and you say, well, I really don't want to get stopped out tomorrow, so I'm going to move my stop down to this previous low because I'm going to bet that's probably support at 115.25 and maybe a smidge under it, say around 114, and we're going to lower our stop. And then we say, all right, we're going to say a prayer tonight, and then tomorrow, it held. Now it's starting to move back up. I feel much better. I love Apple. My life is good. No, it's not. It's going back. Oh, there it goes. It went back up. Now it's going up again. And now we want to go back because we're at that 132 ratio. Now we bring our stop up to here, which is key support, I think. And we grab our little stop button and we raise it up to here. And now we've got our stop at roughly 120. We're at 135, $15 a risk, 120 locks in $10 a gain. We're going to give back $15 if it doesn't work, and we keep trekking on down the road with Apple. And look what happens. Apple hits our target. Now we've got to decide, what are we going to do? Are we going to sell Apple? We're going to keep Apple. See what I'm getting to? This is how I manage my positions every day. And what I'm going to do is I'm going to raise my stop. And I'm going to raise my stop up to here, right in this range. And I'm going to say at 132, because I hit my target, I want my stop here. That locks in a $22 gain. I'm giving up $7 if it comes back off the target. And then I'm just going to trek on down the road. And you can see that Apple floats around, and it goes all the way. You can see it got in that trading range, and then it started up again. So Apple got into a trading range. Another strategy is that you see this consolidation right here. If we move this up, let's grab this trend line right here and move it up. And that red line was our stop. So you can see we got into this trading range. When we broke above it, I could buy more. I can add to a position. That's money management as well. I'm going to stop there, give you a break, take a deep breath, relax, clear the cobwebs out of your head. I know that maybe some of this is new to you. Maybe you're saying, well, Jim, you're being way too elementary. What I'm telling you is that I have met traders all over the world that are extremely talented at trading that do not follow these simple risk principles that eventually make big mistakes. And I've talked to them over and over, and I don't like making big mistakes, and that's why I make a big to-do about this. So let's take that break, and we'll come back for part 4.